Hi, welcome to On the Investor's Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management, and thank you for giving us a few minutes of your time to understand what investors are thinking about right now and how that fits in with building the right portfolio. So as we go through the third quarter's earnings for Asia Pacific, there's been some very interesting developments that we think are relevant to investors, not just for the near term, but also going into the new year when looking into Asian equities. So I'm delighted to be joined by our global market strategist, Adrian Wong, who share with us a lot more about some of the findings, some of the observations from the earnings results so far. So Adrian, thanks for joining us.
Pleasure to be here.
Okay, so let's start with the big question. There's been a lot of discussions about the role of artificial intelligence in driving exports, but also earnings growth across Asia. So can you walk us through how AI is impacting on the region's technology sector and what does that mean for the earnings growth? And also, of course, I think in the last few weeks, there's been some concerns about developments in the US with artificial intelligence. How could that potentially impact on the APAC tech sector as well?
Certainly. So the hardware side of Asia's technology sectors has actually been really empowering global AI developments. And we're seeing that it's still driving remarkable earnings rebound this quarter. Not only just we're seeing a strong demand for AI-related hardware, especially in memory chips, semiconductor chips, we're even seeing demand for equipment needed to produce them. For instance, leading companies in Taiwan, in Korea, and in Japan across the global AI hardware supply chain are actually delivering very strong quarter of above estimates earnings growth. And this isn't really just a story about higher sales volume, because industry supply is actually constrained and demand is so robust. We're seeing suppliers gaining significant pricing power. For instance, in the memory segment, persistent demand-supply imbalance have now actually driven inventories level to subnormal levels, meaning that major suppliers are fully committed for the 2026 output. This means that there's still very little risk of excess supply, and prices are actually being pushed up as a result. Semiconductor foundries are also benefiting, with higher production utilization rates helping to offset margin dilution from their overseas expansion. And in the case of leading foundry names, the scheduled introduction of next generation chips is also expected to sustain elevated pricing over the medium term. Now, if we look upstream, the surge in AI hardware is actually transmitting the demand to semiconductor production equipment industry, where firms are actually seeing another strong quarter of earnings and actually more inquiries for next year's wafer fabrication equipment and custom ASICs tester orders, evidencing this demand-led supply shortage further upstream in the hardware market. While this actually does place somewhat a ceiling on near-term shipment volume, we're seeing this stronger pricing power enabling suppliers across the ecosystem to actually increase their profit margins and sustain earnings growth. However, as you alluded to, it isn't actually without risk, as overall the demand for AI hardware in Asia is highly concentrated, with the US accounting for about 38% of revenue in Asia's technology sector. This means the region is heavily reliant on continued data center expansions in the US, and if there are disruptions, such as supply chain constraints or increasingly energy shortages needed to power these data centers, it could actually have a ripple effect on Asian tech earnings. So while the fundamentals in Asia remain robust, the sector is still very much exposed to risk across the industry and developments in the US. And that's something that we think investors should really keep an eye on.
Yeah, and I think that's a really valid point because if you look at the demand side, whether it is how US businesses or households are adopting AI, there's still clearly a very strong runway from that perspective. And as a result, a lot of these AI hyperscalers are still having a very strong, robust CapEx plan in data centers. But as you rightly pointed out, supply of components or even supply of electricity, these are risks that we're continuing to monitor, and that could have a repercussion on demand for Asian exports when it comes to semiconductors, memory chips, as well as other equipment. But I think the good news is it's not just the US. If you look at, for example, China's developments and also the rest of Asia when it comes to data center establishment, for example, in Malaysia and Southeast Asia, there's still some runways from that perspective. So the fact that a lot of these Asian semiconductor manufacturers are running at capacity, I think that does call for, as you rightly said, stronger pricing power, but at the same time, room for growth in 2026. So obviously, while technology has been grabbing a lot of the headlines, we are advocating a more diversified portfolio within Asia, but also across the world, not just geographically, but also across sectors. Now, are there any other sectors in Asia that's showing strong earnings momentum at this point, or potential for a turnaround, and what's driving the performance?
Yes, certainly. So outside of hardware, we're seeing AI's impact again gaining traction downstream in industries like cloud service providers and internet platforms that operate at the application layer. We're actually seeing these cloud names reporting another quarter of strong earnings, with most citing demand for AI computers that are outpacing supply. And this is especially the case in China, where policy support has been stimulative to push towards a 70% AI penetration rate by 2027. And of course, this has led to more upward revision in CapEx plans as these cloud names race towards expanding their server capacity in order to capture this expanding market. But the industry is also constrained by the shortage of AI chips, as we mentioned. And this has actually led to a trifurcation in the industry's business strategy, where we're seeing some cloud names with proprietary chip capabilities able to accelerate the cloud capacity expansion. Those that had been relying on foreign chips now turning to domestic AI chip solutions, and the others are now prioritizing internal use to maximize efficiency in their AI model development. So, nevertheless, despite these differences, we still see one common thread across the industry, and that's a sustained growth in AI compute demand across the ecosystem. Now, onto the application layer. AI monetization is actually broadening out through different use channels. Internet platforms are now leveraging AI to expand business solutions and drive productivity-led margin expansions. For example, these AI-powered mobile apps have shown higher precision in their customer targeting and marketing. Like how you and I have probably noticed our web searches nowadays are turning and returning better search results. And these cases advertise products placements. Other examples also include launching new premium features like AI-powered document processing and photo editing. And these internet names are actually reporting an increase in new users and subscriptions, which immediately enable their AI monetization into their business revenue. So looking at developments in agentic AI as well, which is the type of AI that can act autonomously to perform complex tasks, we're also seeing these internet names advancing model deployment, especially in the commerce space, to handle proactive sales and recommendations, which again opens up new revenue opportunities for AI monetization to expand into.
Great. So I think on top of the hardware that we discussed earlier on, I think we're quite quickly moving towards the application end of artificial intelligence adoption. And you can argue that what's happening in the US, which is more of a subscription-based model, versus China or Asia, which is more integrated into existing applications and services. These are two very different models in how you monetize AI developments. And in both cases, I think there's still very promising prospects ahead. So we've talked a lot about technology and AI. Obviously, we've got some headwinds for consumer-focused sectors across Asia, and also in terms of automotive companies in Asia as well. Tariffs, changing consumer behavior are clearly putting pressure on these sectors. How are companies in these sectors responding to these challenges, and do you see any signs of improvement?
Yeah, so as you mentioned, like these consumer-focused and automotive companies in Asia are actually seeing quite significant headwinds recently. First, on the consumer discretionary space, especially amongst the commerce platforms, the competitive landscape has been really intense, especially in China's food delivery industry, where, for examples, we see companies now being gridlocked into an unsustainable subsidy war, which is actually leading to steep losses over the quarter. And in some cases, these names are actually expecting continued losses into the next quarter. However, it is still early to say, but we're seeing some early green shoots for the industry. For one, management teams are starting to see consumption on a mild recovery trend ahead of the upcoming spendings by the Lunar New Year. Anti-involution measures, which are policies aimed at curbing irrational competition, should also put a floor to further deterioration in subsidy levels. And finally, some firms are seeing improved profitability from their overseas expansion, which are helping to partially offset the challenges they face domestically. Now on to the automotive sector. US tariffs have not gone away, and this external headwind expectedly weighed on these manufacturers' earnings. And despite their efforts to mitigate these effects by such as relocating the production to a lower tariff market, most leading firms still reported a 3.6% to 3.8% hit on their profit margins this quarter. But there is a silver lining. The industry revenue has retained positive year-on-year growth, thanks in part to a strategic pivot towards hybrid electric vehicles, or HEVs, which are actually gaining popularity overseas as customers are buying HEVs as a transition purchase before committing to a full electric vehicle. Moreover, of course, with US tariffs having been reduced in both Japan and Korea, alongside the US recent extension of its tariff offset program, these developments, we think, should help profit recovery for the automotive companies in the near term.
So yes, I think the anti-involution drive in China is going to be really interesting because obviously the idea of reducing excessive competition makes sense, but how that's executed and what the result's going to be, I think is going to be really critical for China's corporate earnings in 2026. So I think it's good to see some early signs of positive development, but let's continue to monitor that space going forward. So let's come back to policies to some extent. We've seen Asian central banks able to cut rates in the last year and a half on the back of a softer US dollar as well as the Fed cutting rates. So how are central banks' policies and the broader macroeconomic trends shaping the outlook for Asian markets? Are there any particular policy shifts or risks that investors should keep an eye on?
Yes, certainly. So recent central bank actions have actually been pivotal for Asian financials this quarter, which turned out to be the third largest contributor to earnings growth. As many Asian central banks have been slowing their pace of interest rate cuts, or even in some cases pausing them altogether, this has actually alleviated pressures on local banks' net interest margins, which is a key indicator for earnings. And some institutions even revised their earnings guidance upward in anticipation of a sustained stabilization in the near term. And even though policy dynamics were kind of different within each region, most had been stimulative in nature and positive for banks. Take India, for example. Aggressive monetary easing over the past year has stimulated credit demand and accelerated loan growth, which were tailwinds on net interest income for local banks. Japanese and Korean banks are also benefiting from strong performance in their domestic equity markets, which drove fee income. Not to mention, of course, is the ongoing commitment by these banks to raise dividend payout ratios for shareholder returns. In China, the launch of consumption loan subsidies was also a key positive for loan growth and net interest income. Admittedly, there had been some recent market worries over developer loans and mortgage delinquencies, but bank commentary so far suggests that risks remain contained and given manageable exposure to developer loans and that the loan-to-value ratio on mortgage remains low, hinting that asset quality remains resilient in the industry.
Oh, yes, Adrian, I think that's a really important point because as central banks start to cut rates, what they're doing also is to steepen the yield curve, which traditionally is great for banks because they usually get deposits in the short end and they lend out towards the long end. So that spread widening does help the net interest margin. But as you also rightly said, we are having a much better year in terms of stock market activities, whether it's just simply transactions or IPO activities, and all of these are going to be helpful for the banking sector. Of course, as you also already pointed out, some markets like China, there are some credit concerns, but I think overall the level of capital and resources are sufficient to absorb some of these challenges. So finally, let's wrap everything up. When you look at the third quarter's earnings numbers, you've touched on a number of topics such as technology, AI adoption, challenges facing consumer-focused names in China, and also automotive companies across Asia, and also central bank policies impacting on the financial sector. What does that all mean for investors in Asia when they're thinking about investing in Asian equities? What some of the more effective investment strategies do you think are relevant? Are there particular approaches or asset types that investors should consider?
Yeah, so looking back, Asian equities have delivered a very strong return and performance this year. But much of this has actually been driven by valuation re-rating. And if we look back to longer term history, multiples on Asian equities right now have actually normalized back to long-term average levels. This means that we think returns in the year ahead will have to come from earnings growth and dividend income. And this is where we think most effective investment strategy for Asian equities could be. Our barbell approach with allocation to both high growth opportunities such as leading technology firms that are driving or benefiting from this AI boom, and income-generating assets like high dividend sectors and option overlay strategies. The idea is that this strategy can help capture upside potential from structural technological growth drivers that returns through earnings growth, and also capture exposure to steady income streams that return through dividends, especially in Asian market where we have an abundance of tech companies and high dividend names.
So I think there are plenty of opportunities in Asia Pacific equities in 2026. Of course, we are conscious of some of the challenges, for example, valuations, as well as uncertainties coming from artificial intelligence development. But on balance, we do think there are more opportunities emerging for investors. And as Adrian rightly said, there are plenty of strategies that one can adopt, whether it's high dividend strategy or even using option overlays as a way to generate income for investors. So Adrian, thank you very much for joining us today.
Thank you, Tai.
And thank you for joining us on this episode. If you found it useful, please share this with your friends and colleagues. And of course, consider subscribing. If you have any questions you would like to ask us on this podcast, please reach out to your JP Morgan Asset Management client advisors. I'm Tai Hui. I'll see you next time to discuss what's on the investors' minds. Meanwhile, stay informed and stay invested.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase and Company and its affiliates worldwide.